Good morning, students. Today we are going to read the incidence of taxes in the topic of determination of the market price in the subject of economics O levels. So concentrate yourself. Here we are going to start. The incidence of the taxation. The term tax incidence refers to the burden on which a tax falls. The initial tax impact or the tax incidence of a tax on tobacco, for example, may be shifted backwards to the factors of the production. So definitely when the tax will be applied, so the first effect will be backward. So the burden has to be beared by the producers and the wholesalers. This means it is the importer, wholesaler who has to pay the tax to the authorities. However, he is likely to pass on some or all of the tax. It depends on the product in the form of the higher prices to the retailers and the consumers. Whether or not a tax is fully shifted forward will depend upon the price elasticity of demand and supply for tobacco. If the consumer does not reduce his purchases following the increase in the price, that is perfectly price inelastic demand. So if the purchaser is not willing to reduce the purchases, definitely the producer will be encouraged to pass on all the burden or maximum burden to the consumer. Then he will bear the whole of the tax. If he does not reduce, if he does reduce his purchases, that is not perfectly price inelastic demand, then the wholesaler and the retailer will also be worse off and will be bearing part of the tax. So if because of the higher prices, which is actually the result of the implication of the taxes applied by the government, if the consumer is willing and able to reduce the purchases, definitely then the retailers and the wholesalers will have to bear part of the taxes, and they will not pass on the full taxes to the consumer. In general, its shareholders, its employees, or its customers must pay a tax. Let us consider the demand for two goods that have different elasticity, good A and good B. Let us consider what would happen if a tax of the same rate per unit were now imposed on the both goods. So here is the graphical representation of the two products. One is good A and second is good B. And this is good A, which is relatively elastic demand, and this is relatively inelastic demand. So this is a product where consumers are not willing to reduce the demand to much extent, but this is the good in which the consumers are willing to reduce the demand by a great extent. So definitely in this case, part or small portion of the taxes will be passed on to the consumers, and in this case maximum part of the taxes will be passed on to the consumers. Okay, look now, very important point. On any graph, the upper part of the tax is paid by the consumers, while the lower part of the tax is paid by the producers. So look now, here we are going to discuss the diagrams. So P1 was the pre-tax price and P1 was the equilibrium price before the tax, and P2 is the post-tax price. Okay, now you can see this is the tax, that is BD, that is gained by the government, and in BD this portion BC will be beared by the customer or consumers, and CD, this is the part of the tax that will be beared by the wholesaler or the retailer. And the income of the government will be this tax portion, that is like BD into quantity Q2. So BD into Q2 will be the income of the government in the form of the tax. And in this product B, this is relatively inelastic demand. So you can see uh, P5 was the pre-tax price and P4 was the post-tax price. And in this, GI is the total tax that is gained by the government, and out of GI, GH will be beared by the consumers and HI will be beared by the wholesalers or the retailers. And the government's income in the form of the tax in commodity B will be GI, because this is the tax into quantity 4. So GI into Q4. So look now, for good A and B, pre-tax price was P1 and P5. Tax per unit is BD, and in commodity B, GI. Post-tax price was P2 in the case of the A, and in case of B is P4. Consumer's burden is BC, and in the case of the B is GH. Supplier's burden is CD, and in the case of the A and in the case of the B is HI. In the case of the good A, the market price is now P2 rather than P1. So look at the diagram again and again, because I have explained the diagram to you people, and now we are going to read its explanation. The tax per unit is BD, of which the consumers pays BC in the case of the good A, and the consumers pays only a small part of the tax burden. Okay, because consumers are paying only a small part of the tax burden because they are able to reduce their demand to a greater extent. So the wholesalers and retailers are not in a position to pass on the major part of the tax to the consumers. The suppliers has to bear most of the tax burden since demand is relatively price elastic. In the case of the good B, the rise in the market price is from P3 to P4. Here the consumers pays GH of the same tax per unit GI. In the case of good B, the reverse happens. The supplier bears just the amount AH, that is a very small part of the tax burden. The supplier is able to pass on the tax burden to the consumer if the demand for the good is in the question is less sensitive to changes in the prices, that is, has an inelastic demand. The lower the elasticity of the demand, the more inelastic. So this is the point to be noted. If the goods are more inelastic in demand, the higher the burden of the taxation will falls on the consumers. And the reverse is the case. The more elastic the demand, the higher the burden of the taxation that falls on the producers. The government's revenue from the taxes for good A is P2 P3 into Q2. The government's revenue from taxes is equal to new equilibrium quantity multiplied by the value of the tax per unit. Okay, here comes the case of the subsidies, that is the reverse of the taxes. Subsidies are the government grants to the suppliers. They are sometimes regarded as the negative tax. Subsidies are particularly important in agricultural sector. They lower the cost of bringing the goods to the market and increase the supply. A subsidy will shift the supply curve to the right, causing the price to fall and the quantity supplied and demanded to increase. The effect of the subsidies on the equilibrium price. When the subsidy is provided to producers, it has some economic effect as decreasing the cost of the production. So definitely when subsidies will be given by the government to the producers, the cost of the production will be reduced. The producers will be willing and able to produce more and supply more. And because of the excess supply in the market, there will be downward pressure on the equilibrium price to restore as the new equilibrium price that will be lower than the previous equilibrium price. So that will be the effect of the subsidies. So when a subsidy is provided to producers, it has the same economic effect as decreasing the cost of the production. the cost of bringing the goods and services to the market are now decreased by the amounts of the subsidy. So look at the table below. Commodity W has a market price of the £6 with supply. So look now, I'm going to show you the table directly. So before the subsidy was given, so this was the equilibrium price, that was 6, so quantity demanded and supplied was 500. But when the subsidy was given to the producers, definitely they will be able to produce more and supply more. So definitely new equilibrium price will be set, that will be below the previous equilibrium price. So the new equilibrium price is now £5, and they are actually in the market, the new demand that will be more created in the market, that will be 600, and the producers will be able to supply more. So this new price will be set after providing this subsidy to the consumer. So this is the graphical representation of the case. So this was the original supply and this was the demand. So the before giving subsidies to the producers, the equilibrium price was 6 and the quantity demanded and supplied was 500. But after giving the subsidies, definitely the cost of the production will be reduced. The producers will be able and willing to produce more and supply more. So supply curve will be shifted towards right. So this is the new supply curve, and here because of the excess supply in the market, definitely the downward pressure will be applied on the equilibrium price to restore the new equilibrium price. Definitely now the new equilibrium price will be set at 5 and new quantity demanded and supplied will be 600. So this was the case, students. I hope so this will be much more easier and interesting for you to understand now. So read this lecture again, understand it, learn it, and make your notes. Thank you so much.